What is up, all you real estate loving individuals? This is episode number 27 of the Real Estate Take Podcast, and I'm your host, Wendell Butler. This is your go-to podcast for tons of information regarding the current real estate market, where we get various real estate professionals' current take on different areas of real estate. For today's guest, we have Kevin Bupp. Kevin Bupp is a founder and CEO of Sunrise Capital Investors, which invests in mobile home parks, parking lots, apartments, offices, and single-family homes all across the U.S. He has 16 years of experience in educating investors to locate, acquire, and create higher-than-average returns from the widely misunderstood niche of mobile home park investing. He shares his expertise through the Mobile Home Academy, and also as the host of the Real Estate Investing for Cash Flow podcast. He has become one of the hottest real estate podcasts on iTunes. He's a #1 best-selling author of the new book, The Cash Flow Investor: How to Create Financial Freedom Investing in Commercial Real Estate. So let's get Kevin on in here. Kevin, how are you doing today?
Wendell, buddy, I'm doing great, man. Thanks for having me. And I think that one sheet, we need to get you an updated one, but it's okay. So I think it's a couple of years old, but we don't do the Mobile Home Park Academy anymore. It's been many years. And anyway, just there's a couple of things in there that it's probably 4 or 5 years old, my guess would be.
Yeah, must be. Yeah,
but
that's okay.
I'm just older and seasoned now. That's all.
Yeah, either way, you got the experience, you got the expertise on it. So it's not like it was lying or anything. It's just a little outdated, I guess.
No, I'm just older.
Yeah, just older. More wise is what they say.
And there you go.
So yeah, we can just get started just basically talking about more who you are and kind of your backstory and how you got into real estate in the first place. And I'll just let you take it from here.
Yeah, no, again, appreciate having me on the show. Yeah, so I got started like a lot of folks in single family stuff. I kind of joke and say that real estate found me. I didn't find it. So I graduated high school, wasn't really all that academically driven, wasn't super excited about what I was learning, because no one ever showed me like how that was going to be applicable, right, in the real life. And so I barely, skated by in high school, graduated, and then just didn't really have all that much excitement to go off to school like a lot of my friends were. I just knew as though I'd probably party and waste my parents' money. And we weren't rich. My parents both worked, full-time jobs. We didn't have a lot, but never went without, right? So very much your typical collar, dual working household. So, but with that, I got out of high school and got a job bartending in Pennsylvania. You only have to be 18 to bartend. So I actually had an older brother. He was like 6 years older than I, and he had bartended in college, and he used to talk about how much money he made. And so I'm like, well, that seems like fun. So let's go do that. And so I started going to community college, was tending bar on the weekends, having fun, making money, but not really clear with where I was going to go. But at the age of 19, I was dating a girl, and her mother had recently been divorced. Her mother started dating a guy named David. David happened to be a local real estate investor in the area where I grew up. And so after meeting him a number of times at their house, having great conversations, not really understanding what an entrepreneur is, not understanding, I've never met a business owner before. My parents didn't have friends that owned businesses. So like it was like a foreign world to me, because he was around often. He'd be around during the daytime hours sometimes, when in my mind, old people should be at work, right? 9 to 5. Yeah. Like, what are you doing here at 2:00 in the afternoon? And so anyway, David and I became friends. He was about 20 or 25 years older than I was. So, I mean, he was basically my parents' age, but we had good conversations, and I got to know him and ultimately realized what he did to a certain degree. He owned rental properties. He had been doing it for a long time, and that basically paid for his lifestyle. And it didn't start that way, but he built up a portfolio over time and basically lived off the income. And so that was intriguing to me. I still didn't really fully understand it, but basically long story short, David invited me to a conference that he had paid for down in Philadelphia. It was a 3-day, how to buy and fix and flip homes, wholesale homes. It was put on by Ron LeGrand, which is like one of the old OGs in the industry. I think he's still floating around today, but in any event, I went to that event with David, and I was super excited and met a lot of people that I didn't feel were any smarter than I was, just knew a little bit more about this real estate game, and when they were making a ton of money, at least in my mind, they were cashing, $5, $10, $15,000 checks. And that was just mind-boggling money to me at that point in my life. I just envisioned what I could do with a couple of checks like that, right? Yeah. And so with that being said, I didn't know where to take that excitement or that energy leaving that conference. I just knew I didn't want it to dissipate and go away, because I'd go back to the normal grind, tending bar, going to school with no direction, right? And so I made David an offer he couldn't refuse. Again, he was about 25 years older than I, and so he was a solopreneur, did really well, but a solopreneur, kind of didn't have an assistant, kind of managed everything. He took phone calls from prospective tenants, he signed leases, dealt contractors, did all that stuff. It was just busy work, right? And I saw him struggle with technology. So I made him an offer he couldn't refuse to come work for him free, because I had a lot of free time during the day. I took 12 credits, and so I literally had a lot of time in my daytime hours, and I didn't typically have to work until Thursday, Friday, or Saturday night, and it was pretty late evening. So I had a lot of daytime hours available, and so he accepted. I went and worked for him for free, basically helping him and all the crap that he shouldn't have been doing, right? And by doing that, I got to be around him on a regular basis, and I got to go to job sites with him. I got to go meet with prospective tenants. I got to drop drop off leases. I got to listen to him talk on the phone to people that wanted to sell their house, right? He's trying to buy it from them, or talk with his investors. And I listened to all this, and I just learned by doing, and just through osmosis, I was surrounded by this information. And so fast forward 14 months, I bought my first property at the age of 20, and with bartending money I'd saved up, leveraged some relationships I had met through David. There was one of his private investors that offered to do some financing for me. And so I bought that first property at 20, and that was the kickoff of it. However, I learned very quickly, David, it was like buy and hold, buy and hold. And David had been doing this like 20 years, right? So I learned very quickly that I bought this property, we got it renovated, I got it rented, and it was kicking off a few $100 a month of cash flow. And I'd used basically every dollar I had to buy it. And I realized it was going to take me a long time to get to a point to where I could do a cash out refinance, or, have enough income from the cash flow saved up to go buy another property. And I didn't have the deep enough relationships yet. That private investor did me a favor by lending me money just because of my relationship with David. But I didn't have the track record or the financial wherewithal to do what Dave was doing by holding everything. And so I modified it very quickly I sold that property, and then I got my marketing engine kicked up, and I started wholesaling a couple homes, keeping one, wholesaling a couple homes, keeping one. And that became the model for the first couple of years. And then really I fast tracked it. My early to mid 20s, I ended up really modeling David's methods, and I ended up building up a portfolio of about 122 single family homes, and then a few hundred multifamily properties. This was leading up to 08, and then lost everything, started over again. And it really brings us up to where we are today. I took about a 3-year hiatus from 08 to 11, just running damage control. This is down in Florida now. Pennsylvania is where I grew up. I moved to Florida, and everything that I lost was down here, but ultimately started over again in really late 10, early 11. And that's when I got introduced to mobile home parks. And so I really tried to identify what I did wrong first time around, not to try to make those mistakes again, but create a more efficient business, something that was more scalable, that I could create enough revenue where I could hire people that were smarter than I within the organization, and grow something that was truly sustainable. Because prior to that, it was just me. And so that's where we're at today. So I kicked that, I guess, the second phase of my journey off in 2011, bought my first mobile home park. Today, we own about $350 million of assets across, I think it's I was telling you earlier, I always lose track. I think it's 14 different states. And then outside of mobile home parks, we also own parking garages, parking lots, and we've got about 150 million of parking asset that we own and operate throughout the country. So fast forward to where we're at today, the business looks really different today than what it did back then, but wouldn't trade any of those challenges or just, lessons that were learned, trials and tribulations. I wouldn't trade any of that in, because it ultimately helped me grow what I've created today. So anyway, that's a condensed 20 plus year version of the business. But I've owned just about everything now over the time. I've owned some other types of commercial real estate, dabbled in some self-storage, some office, way back in the day, retail. Still own some of that today. But our primary two vehicles that we focus 99.9% of our energy in is mobile home parks and parking.
Love that. Yeah. So you have a lot of experience to talk about too, especially from switching from single family residential type area to even apartment complexes to now mobile homes, and the differences between all three. Let's go all the way back to where you first got started in buying single family homes and things like that. What do you think has changed from back then, and how you were building kind of your single family portfolio and multifamily portfolio then to today? Yeah. And did that market change and difference in that aspect make you kind of decide to go to mobile home? Was it for kind of recession proofing because of the 08 that might have made you realize that it's a little dangerous to have such a portfolio of just single families and vice versa? I don't know. But
that's a great question. I mean, there's a couple elements there. It's not just hey, single family doesn't work, because it does. But there's a couple things. Number one, the Florida, and I'll talk about, we own things in 5 counties, Tampa Bay and then south. In Tampa Bay, while it was a developed area, south of it, there's cities, but there wasn't a lot of economic base. So what's very different today than back then was there's a lot more major employers here on this part of Florida than what existed back then. And so back then, a lot of the jobs were fueled by construction. And when the real estate market dried up, so did a lot of the jobs. I mean, in fact, there's a term that came about that maybe a lot of people haven't heard before, but halfbacks. Basically, what occurred is you had this mass exodus of population because there was no jobs back then, and people were literally leaving Florida. Maybe they came from up north. They came to Florida for sunshine and work and all this great thing, economic boom that was happening. But then when it all dried up, they went halfway back to the north. They ended up in Tennessee or Kentucky or maybe, the Carolinas somewhere. And so, there came the term halfbacks. But basically, today, Florida, all the major markets of Florida look very different from an economic base and diversification base and what they did back then. So that's a big thing, right? You can't really hang your hat on one industry, because if that industry goes bye-bye or gets outsourced, whatever happens to it, then you're stuck. Your tenants can't pay rent. And if they can't pay rent, then you're in a world of hurt being a landlord. So that was a big change. That today it looks very different. And then the second thing, I think, just speaking to single family stuff. Again, there's institutions in the business. There's lots of guys that have hundreds of units in a portfolio. And I'd say that the one big thing I identified that really changed from like today to back then is technology has made a world of difference in creating efficiencies with managing, single family properties or just scattered properties even, right? Like back then, I literally had leasing guys and gals that were out driving from showing to showing. You couldn't do virtual showings, right? Like you were showing up. It was so inefficient, which is gas and time, and same with the maintenance guys, right? Like just inconsistencies across the board from one house to the next, and just burning cash left and right on the management side of things. And so that's very different today. There's a lot of technology that has enabled folks in this industry to be a lot more efficient than what existed back then. And all those technology advances have also been applicable to multifamily, basically any other area of real estate. But single family was incredibly, if you own stuff that was scattered amongst, again, I'm talking 5 counties, and that was probably from point to point, probably about 180 miles in one direction. Yeah. I mean, like that's not efficient, at all. It's just not. Yeah. And so during that time when I owned that single family home portfolio, I had started buying as more of a passive, another partner that was really into like the smaller multifamily game. When I say small, I mean like probably small as 12 units and as large as like 72. So kind of, I guess, maybe medium sized multifamily. And I started putting money in those deals. And then really what I identified was that those things operated way more efficiently. The maintenance costs and the management, just the overall operation side of it, the operating expense ratio was significantly less than my portfolio of single family properties. And so, but that was leading right up to '08. And so when I identified like, hey man, I should be spending more of my time over here. Business just runs better. And I could buy 12 units, 30 units, 40 units all in one fell swoop when it took me literally 6 years to buy 122 single family homes, right? Like, and back then when I was going to business, I was single. I didn't have a wife. I didn't have kids or any of that. And so I love work and I love the hustle. But so fast forward to like the rebuild stage, like number one, I got married. I literally got married in 2010 after the crash, realized that we wanted to have kids. We're not in the financial position to do so, but I was like, okay, I'm going to rebuild this thing, but how do I do it better maybe the second time around? Not better meaning like, again, one asset class is better than the other, but just for me, like more efficient. Because for me, like you can't hire people in your business unless you have revenue, and you can get to a higher top line revenue with more units, right? Faster with more units than if you one by one. And so I was like, man, I got to do this differently the second time around. I want to be able to start hiring like a right-hand person, an admin assistant, someone like in short order, right? And so I need to be able to buy more units. And I got introduced this accidentally to mobile home parks. So like this wasn't like, in my mind, I was going to go buy multifamily again because multifamily was in the dumps too. Like there was a lot of opportunity, lots of foreclosures, lots of things you could buy for like literally pennies on dollar in the multifamily space. However, I met a guy for lunch one day just through a friend, and he owns some mobile home parks, and like I had never considered it as a class. I'd never really looked at anything, and he got me so excited in like this 2-hour lunch meeting as to why I should go buy a mobile home park and not look at multifamily, that I went and did it. So I still look at it as multifamily. It's just a different version of it. Yeah, that was 2011, and I bought that first asset in Atlanta, again far away from me, but it was big enough to where we could have an on-site manager. We could like literally pay the payroll of an on-site manager. So while I went there often to get it turned around and get it stabilized, once it was stabilized, I'd maybe visit it once every 6 months, once every 8 months. We had a handyman on site that would do any repairs and maintenance. And so again, just looking at that compared to if I had a bunch of individual homes, it looked very differently. It operated very differently and operated way more efficiently. So that's really what pushed me to kind of refocus my efforts the second time around on multifamily, because there was an opportunity to scale a lot faster. To me, you could do that in any asset class. I like housing because I understand it. It's easy. Everyone needs a roof over their head, right? And so, but I wanted to be able to get to a scale fast enough that we could start building a team where I could get people underneath me that could create a business that I felt was sustainable. I knew it was going to take a lot of time, but I wanted to get to the point to where we could hire the talent that was necessary to build into an organization that could kind of live and breathe on its own. So if I went away for a week or 2 weeks or a month or two, whatever it might be, that I know that there's smarter people steering the ship than probably myself in the various departments. So that was a long-winded answer to your one question that you had, but
no, that's a good answer, because like every asset class has different ways that you have to treat them and kind of run that business. So like for nowadays, it's not the same in the single family realm as it was back in the day. I mean, first of all, the pricing is totally different. The rents don't really work as well for single family at all anymore in most markets. Some markets it does work, but you just have to look at like the right asset class to kind of strategically use those, move your business forward in the right way, which is exactly what you did, because you had a goal of creating creating a business that kind of runs itself, breathes out on its own, that you put smarter people in place that you can then just kind of focus on looking at the deals, making the higher level decisions, and then have a team that kind of runs the operations, because that's just not what you wanted to do, because you found that you're important at finding the actual deals and getting it done rather than being so hands-on and in there. With your original portfolio of the single family homes, it was a lot tougher to do that, especially with the technology, which makes total sense because you have to drive 160 miles back and forth between single families, and they probably weren't cash flowing like a ton. You had to have so many to cash flow enough.
Yep,
And
that's right.
And it gets to the point that you're like, oh Jesus, I could just go buy I have 120 single family homes. Why don't I just go buy like 150 unit apartment complex?
Right.
It's the same
do that.
thing.
Yeah, same transaction. Yeah,
it's all in one
same
place.
amount of time in the transaction, bigger transaction, but same amount of time, effort, and energy to buy maybe one single family. Maybe not the same exact, but like generally speaking, it's apples to apples, one transaction. Except one is 150 units and the other one is 1 unit.
Yeah, I love that point of view, because it's kind of the point of view that I take too. Is I utilize single families as a flipping source to create active income to then put into multifamilies that have a lot more passive income type numbers. It makes more sense. And you know the saying, like they say, the bigger the deal, the easier it is. It kind of is true, because larger it is, more gross revenue you have coming in, and then you have a lot more opportunity to raise that revenue, increase the equity of the property, force appreciation. They can also have a lot more money that's coming in from the rents to then make changes of the property and even their staff and et cetera like that. But like with a single family home, you buy it as a rental, you're going to maybe cash flow like $100, $200 a month, and you don't have anything to do. You can't hire anybody to really help you until you get it done. And like you said, buying a single family home is similar to like just buying a 100 unit apartment complex. There's a little bit more due diligence in each, but it's the same process. Like you're just buying a building. One building comes with units.
Yep, exactly.
I love that point of view, and I love that you broke that down for us, because a lot of people don't kind of like try to hop into real estate, and like a lot of entrepreneurs in real estate have shiny object syndrome. They'll hop in and they'll try like a ton of different things, and they don't really pick like a niche or really think about kind of where they want their business to go long term. But you have to look at asset classes within real estate to support your vision and your goal for your business. And for some people that might be single family, some people that might be multifamilies, for some people that might be mobile homes, some people that might be building, lands, titling, all that stuff. But you just got to kind of look in the future of where you want to be, where you see yourself in 10 years, and then find that class that's going to support you the best, which is what you did, which is perfect.
Yeah, no, I mean, and there's I always say I joke say there's a million and one different ways to make money in real estate, right? Like there's no right or wrong. There's not one that's I can argue, probably put up an argument and debate that like why mobile home parks are better than this, that, or the other. But at the end of the day, you can hopefully probably argue the same thing about whatever your focus is. And so really it's pick a lane and become an expert in it. And it takes time to get there. Like for example, like the mobile home park thing, we only focused on that until about 5 years ago. And it was very difficult decision for us to consider bringing parking into our fray, like into our world, because we didn't want to dilute focus, and we can only be great at so many things at one time. So it was actually a multi-year discussion before we made the decision to start buying parking. We loved the asset class. We had studied it, had learned a ton about it over a number of years, but then finally decided to pull the trigger, and it's been great. I'm happy, but it wasn't a overnight decision. I didn't go to a conference and say, oh man, that's great. I heard this guy made a lot of money in parking. Let's go buy one, right? And so like you got to stay in your lane and stay focused, and know that it's going to take many, many years for you to truly be an expert. Maybe you'll understand it, to really understand and gain expertise to be viewed as like a leader within your industry. It's going to take time to get there. So
yeah, it's kind of, I blame social media and all that BS that comes along with it that makes people kind of confused about the way to approach entrepreneurship, because there's videos that people like every millionaire or whatever multimillionaire has 7 streams of income. It's like, sure, they do, but the way that they got there was by focusing on one niche that they were really good at, and then they got really an expert at it, grew that business to the point that it can then almost run itself, make a ton of money, and then they started investing in other things. You don't want to just go in and be like, I'm going to do this, 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 and this, because you're going to get pulled in so many different directions. You're never going to get good at one thing. You just become just instead of a master of one, you're a master in none? I don't know. I'm trying to be weird.
Yeah, no, that's right.
There. But you want to be a master of one, because then you can be really good at that. That's gonna you pull as much, I guess, money, growth, etc. out of that, and then you get to a point that when you're comfortable, you can start investing in other things. And that's something that I had to go through as well, getting into real estate, because I was doing multifamilies. I was trying to do like fix and flips. I was trying to do like wholesaling. I was looking at like Airbnbs, because like everything starts hitting you left and right, and you're like, oh, that sounds good, because you hear all these stories. But then I realized, hey, you just got to focus and grind down on one thing. And then ever since I started doing that, my business has been growing a lot more, and I just have a lot more opportunity in the future because I'm growing that one part of my business to kind of support the rest, because you have to have like
and then even to that point, in the beginning, I guess the second time around, we started buying parks. Well, I always like to, I do think that real wealth gets created by holding real estate assets a very long time, assuming that you're buying the right asset in a great market, a growing market, not one that's people are exiting or moving out of and industries are moving away from, but a growing area that you'll do incredibly well long term if you hold. And so, but the challenge with that is that you need to recycle capital when you're just getting started. You might only have a certain amount of money you're starting with, right? And so while you might put it into an asset that creates monthly cash flow, it takes a very long time, especially if you have to live on that cash flow. It takes a very long time for you to save enough maybe to go buy another asset. And so in the beginning, we held things for a number of years. We would buy them, fix them, stabilize them, add value to them, cash flow them for a couple of years. But we've sold a lot of things. I think we've gone full cycle in about 20 mobile home parks over the past 6 or 7 years. And some of those I really didn't want to sell. I just really didn't. But I knew that in order for us to really catapult our business, I needed to be able to tap into that, not just maybe the $100,000 a year, $150,000 a year it was kicking off in cash flow. I need to be able to tap into the $1.5 million, $2 million, $3 million of equity if we actually exited out of the deal. And I know that a lot of people argue the cash out refinance, but there's still limitations there of like how much cash you can get out at one time. And so we made some tough decisions to sell some properties to get that big hit of capital so that we could literally turbo boost the company, make some additional hires, aggressive hires, and bring some more expensive talent into the organization that if we'd have waited or done it the slow method would have taken us another 5, 6, 7 years. And so again, kind of like your point, like you need to make the money first before you start diversifying and maybe even just holding things for a very long time. Because again, real estate, most of the get rich quick stuff, I think there's a way to get rich quick, but most of it's buying and selling. Like you said, the active income, you can make a ton of money doing that. And it's a lot of freaking work, especially to do it at scale, but you're not going to get rich quickly if you're just buying and holding stuff. Just the cash flow is there, but like there's probably other types of businesses where you could generate much greater cash flows if that's the plan on a monthly and an annual basis. So anyway, real estate's wonderful, but like there's other opportunities as well. Like just you got to get back to picking your lane and just understanding the business, but not just the next like 1, 2, 3, 4, 5 years, but like what's it look like in 15 years and where do I want it to be in 15 years? And then backing into it, who the hell needs to be on the team? Who do I need to hire? How many transactions do I need to do? How much capital do I need to raise? Whatever that is, like back into how the hell do I get there? Even like we went through an exercise years back, start building out accountability charts, like organizational charts also. We use EOS, and so they call it accountability charts, but organizational chart of who's in the organization, what position do they hold. But we went through this exercise many years back of like in 5 years, in order for us to get here, who needs to be on this team? What's their salary going to be? What's their roles going to be? Just what does the organization look like? And like have that really vision mapping more than anything else. Like that's where we're driving towards. That's how and how do we get there? I don't know how yet. I have no idea how, but I just know that we have to get there one way or another. So every decision that we make needs to be guided towards that Northern Star. So that's probably one of the most helpful exercises we've ever done in the organization that really allowed us to see a massive growth spurt in the last 5 years. Is that right there?
Oh yeah. I have a buddy that is building his business right now, and he focuses on apartment, like smaller multifamilies, so like 7 to 12 units on average, but they've grown from like 30 units to like 350 plus within the past year and a half, 2 years, but they started hiring people. And it's amazing how if you don't take a step back from your business and kind of look at it from like the outside and look at like the organizational chart and look at like what you need, who you need to hire, kind of where to steer the ship, you can get so involved in just the business that it doesn't really grow. It just keeps on, you kind of get like stuck and you kind of just are working in the business instead of on the business. And taking that step back, like what they did as well, they did the same thing. They don't use EOS, but they use like a culture index to start like surveying employees and figure out who fits in the best places and what they need based on like what they're good at and who to support them. I started doing that, and ever since then, it's been like so much better for them. And it's crazy that some people, all businesses are pretty much the same. You need to hire the correct team that works the most efficient to get to the goal that everybody that the business wants to get to. And it's just super interesting, like looking at that and hearing other business owners talk about it as well. Because people don't really talk about how to work on your business and kind of that aspect of it. They mostly just talk about what they're doing as a business, when the most important part of business is actually running the business, like the team, the people that are within it to help you move forward. And everybody thinks about real estate, think about buying buildings, buying properties. It's all about properties. But real estate is 100% just, it's a person-to-person business for sure, because you're dealing with sellers, you're dealing with other investors, you're dealing with employees. And it's really just all about the people that you bring on the team and work with to really allow yourself to grow. And Yeah, I just love that you touched on that real quick because not a lot of
Yeah.
people touch on that and bring that up. And it's super important in all businesses as well. So I want to bring you back just to talk about purchasing like a mobile home park and kind of get a little bit more into the details of that. Is there like a recent one that you've purchased and kind of what is your process of looking at it? What's different compared to that and looking at a multifamily? Like what aspects are you looking at?
Yeah.
And then also what has changed over the years of like how much different your due diligence is on it and what have you gained from like your experience to like look at different aspects out of it to make a better buy?
And I'm not sure there's many things that are different of if you're doing the appropriate due diligence on a 300 unit apartment complex to have a 300 unit mobile home park. I mean, it's just, I really just view them as they're horizontal, right? Like it's a horizontal apartment complex to that of maybe a multi-story apartment complex. And so we look at infrastructure. I mean, like the biggest area, at least I'll speak to mobile home parks. That's what we're talking about here. The biggest area where I see people shortchange due diligence and then maybe even lose their ass because they get surprised with a 6-figure, 7-figure expense down the road is in the infrastructure. And that means water lines, sewer lines, potentially roads, but basically the things that you can't see for the most part below the ground. And then on top of that, one of the things that are kind of unique with mobile home parks, a lot of these were built back, the big heyday was like really the 50s through like the 80s. Like that was a big heyday when the majority were built. And so when you think about that, you're looking at stuff that's got maybe 50, 60-year-old infrastructure, right? Water lines, sewer lines, and every different part of the country's got different types of soil. Things don't last as long in certain areas, like maybe high mineral content, right? What they were using back then as far as water lines or sewer lines, like cast iron just doesn't hold up in certain environments all that well, and it kind of rusts out and you've got a lot of problems. Or pretty common type of sewer line used way back when, which is it's great for a very long time unless you've got a lot of trees. It's clay tile sewer lines. If you got a property, maybe back then when they built this property, they just planted some trees because they had a vision what it's going to look like in 50 years, but they didn't really think through that these trees, other than being beautiful and just providing a shaded environment, were going to wreak havoc on the underground infrastructure, which is going to cost hundreds of thousands or millions of dollars down the road, right? So we spend quite a bit of money hiring engineers, hiring folks to do camera scopes throughout the entire community, just to really get an understanding of what's needed today, the current condition, what's needed today, what we're going to have to build a capital budget out for over the coming years, and just make it a lot of decisions die on whether or not we're going to buy a property based on the underground due diligence that we do. And then second to that, a lot of these parks, again, were built a long time ago, and most of them were built kind of on the outskirts of town. While you might see mobile home parks now that are maybe kind of in the urban core, maybe urban sprawl even, they probably weren't 70 years ago. It's just that the city kind of built around them. And so a lot of these properties you'll find, not a lot, but there's a lot, we own a number where they have private sewer systems, meaning like literally like the wastewater treatment plant that treats the city's sewer and water where you live, miniature versions of that on site that we basically have a whole treatment plan. And so those are incredibly expensive. You got to have a licensed operator run them. There's repairs and maintenance. There's upkeep that you have the budget for. And they also don't last forever. And so I've seen people get into a deal. They don't do necessary due diligence. And then that thing goes bad. And not only do you have to replace something that costs 7 figures, but you've got now, there's no way to treat the actual sewage coming in from the 150, 200 residents you have in the park. And it's a big debacle. It becomes a major decision or major problem. Same thing with the water. You got well systems, right? Sometimes if you're not on municipal water, you got well systems. And so it's different. If you got a single family home with one well, it's treated very differently in the eyes of the EPA or whoever your environmental agency is in your state. It's looked at very differently when you're just serving one person to that of when you're serving a community. When we're serving a community, there's a ton more liability that comes into managing a water system. Because now, the funny thing is with sewer systems, you can't poison anybody with sewer. You might have a septic tank that overflows, whatever, but like no one's drinking that, no one's eating that. Hopefully not, right? With a well system, you can absolutely poison people with the water. If you don't maintain your well system, if it hasn't been maintained, if it doesn't have the right updated equipment, if it's not treating the water appropriately, if the well's contaminated, there's all these things that can wreak havoc. Maybe you didn't do your due diligence and you didn't realize that this well system's failing and there's sediment getting in the water. It's high iron content. It's causing problems in the community. I've seen guys, this costs money to get people in there, professionals to actually research and do a deep dive into those systems. And then outside of that, I think it's just understanding, and this is applicable to any type of real estate you buy. Who's the demographic that you're serving? What's the immediate market? Like, what's the submarket that you're in? Is it a great submarket? Has it got good schools? Like, why do people want to live there? Where do people work? We talked about this earlier about Florida kind of being a one-show pony way back when, and now it's not. But like I've seen people buy properties, parks, like good-looking park, but it's in an area that maybe only has one or two major employers. And guess what? One of them goes away. They get offshored, and a big portion of maybe the plant workers or the manufacturing workers or the warehouse workers lived in that community, and they no longer have a job. They
Yeah.
know that that's a problem, but that's applicable to single family. That's applicable to multifamily. And so we just want to know that the market's strong, that people are moving there, that we're in a part of town that people want to live in. We're in a good public school district where even families that are on the lower socioeconomic level, they still want to send their kids to good schools, right? They might be hardworking folks that work at Walmart or Jiffy Lube or whatever, but they still want their kids to go to good school. So we want to know that we're in the right part of town. And that takes research. You can't just look at one website and realize that, oh, I'm in the right part of town. You got to spend time there. Like you got to talk to people, spend time there. For all you know, you might be on the wrong. It might look like you're on the right side of tracks, but you might be on the wrong side unless you get there, boots in the ground, talk to people. And so, even talking to the local municipality, like how do they feel about your community that you're about to buy? Like, do the police make visits there on a regular basis? And you can, these are all public reports. You can go to the police department and actually get a record. They'll print you a record of how many calls have come to your community. What are they? Are they domestic abuse? Are they just civil disturbance? I mean, or is there like violence? Has there been murders? Have there been stabbings? Things like that. You want to know those types of things. You can fix all that, but like you start layering in how much more difficult of a project it's going to be. And it gets riskier. And the more risk means there's a lesser of a chance that you might make as much money as what you think you're going to make on the project. So, I mean, how it looks today versus what it did back then. I mean, back then, and every product we buy, I visit everything. Like I will not buy anything without me physically going there, getting a feel. I know it's weird, but like, I like to like spend a couple days, get a feel and just walk around, talk to people. Just, I don't know, just there's something, I'm not saying that I can't be replaced and someone else in the organization can't do as good as I just feel like I have a good knack for it, good feel for what's going on in the local marketplace. So I go visit everything still. However, I don't necessarily meet with the plumbers. I don't meet with the engineers. I don't meet with the water system operators. I don't go meet with the municipalities. We've got dedicated folks on the team that kind of manage those big aspects of due diligence. And now we've got an investment committee, whereas it was just me before doing that and then making the decision. Whereas today, my partner and I still make end all be all decision, but we've got guys that basically get all the information, get all the intel from the local marketplace, write it up in a report and present it to myself, my partner. And then we've got 3 other folks on our investment committee. One's our CFO, one's our asset manager, and the other one's the director of operations, all which are very intimately involved in the project either before or after we close on it, right? And so I want their input and I want their feedback and I want their just opinion and make sure that I'm not missing anything. So back in the day, it was just me or maybe myself and a partner. But today I take that feedback from them. And so I don't ever trump it like it's a vote. We put it in for a vote and like it's got the majority wins. The majority has to vote that we're doing this deal. And if not, then we'll pass on it. So again, much more involved process, but I think it helps us make better decisions. And again, this goes back to like finding those really smart people that got way more experience either than I, that have built big organizations, that maybe have a financial acumen, a formal financial acumen that I've never had, bring them on and help them, let them poke holes in what I think looks like a great business plan, right? Like, okay, guys, this looks great, but I know there's risks. Maybe I can't see them all. Shoot it at me.
No, yeah. You touched on 2 important things there as well. Cause like you always want to look at like the numbers of the property or the mobile home as like first to be like, okay, does this work? Like, will this work? What is the history of like the rents? What is the history of the
I missed all that stuff. Like I missed like the financial.
Well, that's the obvious.
I made the assumption. Yeah, I made the assumption that like you've done basic underwriting. I won't go visit anything until we've run a financial model on it. And like at a high level, and I know there's things I don't know yet, but at a high level, this could make sense. This could fit our business model. And then we dive deeper. So I should have said that, but I made the assumption that was already done and that you've at least done a back of the napkin or something to determine that this could fit the basic buy box.
Yeah, but like you touched on something after that, it's even more important to me, I think too, is actually going there and getting the feel of the area, because the numbers tell. Always trust the numbers. The data is always very important. But in real estate, again, it's like you're dealing with people, right? So it's not just properties you're buying people's houses, right? And then you're renting to them. And then it really matters how the feel that area is, because if you're buying a mobile home park, right, for example, that the numbers look fantastic on paper, but then you go there, then you walk around the town and it ends up being kind of a rough part of town. And then you talk to like, some people in the town and they're like, you may ask them questions. I would like, do you know the mobile home park, blah, blah. And they're like, oh yeah, that place. Oh, like if there's like a bad vibe for the mobile home park, especially if there's been a lot of like, if there was like you said, like murders or stabbings or something like within the mobile home park, there's just a bad taste in everybody's mouth in that area of that park, which you can still buy it, but you just have to know that you're going to have to change almost the whole brand of that mobile home park. So now you're dealing with not only fixing the numbers, but you're dealing with like the
reputation,
the reputation.
Well, I mean, the bigger part of that, the brand, like you can change the name, you can change signage and all that, which will help you change your reputation. But the thing that that you have to account for when you run into a situation like that, we've run the many, is that maybe you assume that you might turn, like if you bought a 100 space park, maybe you've assumed that you're going to turn like 8 of the residents the first year, right? And maybe that's what you decided is like, that's normalized. Like we're going to turn 8 of the residents, but you realize that you got a ton of shitheads in there, right? Like literally you got 30 of the residents or 40 that are just problematic. And then maybe there's some families in there, right? Like some cousins, some brothers, they own different units. And guess what? You get rid of one, they're probably all going to go. And so like you better fix your underwriting that worst case scenario. I might lose instead of 8, I might lose 25. But now once I lose 25, guess what also happens? I lose revenue, but now I got a ton of additional CapEx expense because I got to go in and fix these units up and get them, habitable so that I can rent them or sell them again. And so you got massive cost, like again, and that takes time. Like you could be down with those units for 6 months if you've got that many, right? And so like massive loss of income, big challenge is that if you didn't plan for that, it's going to maybe, if you got a loan on the property, like you might fall below the 1.25 debt coverage ratio. Like you might throw yourself into foreclosure in the first year and you didn't even realize, like you didn't make that assumption that could happen. And then you didn't budget for the additional $300K of turn costs that you were going to come into because now you have vacant units. So like the problem mounts, like while like larger properties, like you can incrementally increase revenues and then drive huge value, right? Like it's massive, but that can go the opposite direction as well and just smack you right in the face if you don't plan for it. So huge risk, huge reward, right? Like both sides of the equation.
Yeah, you got to do educated due diligence and always do worst case scenario. Like I've seen so many people get burned by talking about just best case scenario. That's all they hang their hat on. And it's like, no, you can't do that.
It was end of last year. It was probably the most costly deals that we did not buy. However, it would have probably the unexpected, even though I think I identified everything that was going to be a problem. Even when you have that many things, 3 communities, there's about 340 sites between the 3. They're all within 10 minutes of one another. So good, nice little portfolio. Every single one of them had underground infrastructure challenges, whether it be deteriorating lines or even like they'd replaced lines a couple years back, but they didn't dig them below the freaking frost line. It was in Michigan. They did a shitty job. They did a half-assed job and they didn't dig them below the frost line. And that creates its own world of problems. Yeah. And so there was about $1 million, probably about $1.3 million of underground infrastructure improvements that were necessary between these 3 parks. That was the things that we uncovered. Like if you start looking at things that are half-assed like that by an owner, guess what? They've also half-assed the residents that they put in there. They've half-assed the day-to-day management. They've half-assed forcing the necessary rules. And so all those unseen things, I knew that were going to come smack us. Like he was willing to negotiate price and give it to us for literally like $1.5 million less. And I'm like, there's just too many things that I don't see. I'm just not willing to do the deal. And so we spent about $120,000 in due diligence that we literally had to eat and walk away from. But my guess is that we would have lost much more than that on the things that we didn't know or the things that we couldn't see because it was just that poor run of an operation. Great area, but just too many variables to get involved. And then on top of that, I looked at it from like my ops team. We got a great ops team, but guess what? It's going to drain our resources to deal with these 3 properties. And every time we drain resources over here, guess what? We're going to miss an opportunity over here. And so it's like just making a tough decision, eating the $100,000. It sucked, but moving on to the next one because really there's always another deal around the corner.
Oh, 100%. And that's kind of like you just sticking to your buy box. I mean, it's important to form kind of a buy box and your parameters and what you're willing to invest in and what you're willing not to. And it seemed like in that portion, you came to the conclusion that it just wasn't worth the risk. Even if you got it for a way lower price, like in real estate, some people say there's always a price that works. I mean, not really, because someone could hand me a property for like $1, but if I have to put in like $1 million to make it worth like $1.2 million and I have to spend all my time doing just that property and doing everything there, it almost becomes not worth it because you're spending so much time to just like put so much money into that building to make, you made money on it. Was that money that you made really as much as you could have made if you were focusing on better deals and allocating your time and money and teams to other projects? That's a balancing act, I feel like, as you start getting more deals in the pipeline, you start experiencing or learning more about what deals you don't want to deal with and what ones you will. And it's kind of a learning curve that I'm sure you've grown to just get better at over your long career in real estate anyway.
So I would have done this deal. I was looking over here at my board to see what we had. And it's still up on the board as a dead deal from like last, because it was like latter half of last year. But we had it under contract for 9.7. They were willing to reduce the price to 8.4. And I probably still would have done the deal. I wouldn't have bought it to keep it, but I literally went back to it. I was like, I don't mean to offend you, but like, this is just where I'm at. Like, this is where my head's at, because I just know there's too many risks here that I don't even see. And it was with a broker. So I want to be very careful not to ruin a reputation or, make them think as a person that comes in and just tries to retrade and lowball. That's not our game. That's not what we do. We close. I mean, this is actually the first deal that we've had in probably 7 years that we've actually backed out on getting that far along, right? I think I would have paid probably like 6-8 for it. And then I would have turned around and I think I could have flipped it pretty easily and made we had the full reports. I would have shared everything, full visibility with the next buyer. I think I could have flipped it for 7.5 and still gave gave someone plenty of meat on the bone and also additional $1 million plus of cushion for them to get in and take on that additional risk that I just wasn't willing to deal with at that point in time. So like I still would have done that deal, but it would have been substantially less. I would have wanted to walk away with $500,000 and then, recoup our costs, recoup some more time. And I would have felt good about that. But anyway.
No, yeah.
But again, some deals you don't want to do that. Some deals you're like, it's just not worth the brain damage. No matter what we do, it's still not worth the brain damage.
Yeah, and you never know too, like if you want to flip it, because I'm sure your plan was like to buy it and just like stabilize a little bit and then get it to the next person that's okay with it.
I'd have probably just done just a high level cleanup lipstick, like not even lipstick. I'd have gone and do tree work. I'd maybe done just minor, demoed some old homes that probably need to be torn down and just make it a better blank canvas for someone else to come in. But I'd have given full reports. I'd be like, hey, we done our due diligence. Here's why we don't want it. That's not a good fit for us. We don't have the time, energy, effort. You guys love these projects. Here you go. Eyes wide open. Here's all the problems with it. There's probably a couple more, but guess what? Like you're buying it at an extreme discount as well. There's enough margin in there that even with a couple additional mistakes, you guys will make money. You'll be happy with it. And I'll be happy as well because I at least got to recoup my capital and make a little bit out of it. But there's still risk on my side because we'd have had to buy it probably all cash. And then literally that amount of cash sitting out of pocket for could have been 4 months, 8 months, a year until we're finding that buyer. That costs a lot of money to have that much money sitting out there. Our cost of capital from our investors is probably roughly around 9%. So you do the math there on that.
It's just that's quick.
A lot of holding expense. You got to move it quickly. And so there's risk there. If you don't move it quick enough, that million you thought or $500,000 you're going to make, you got eaten up in holding cost.
Oh yeah. That's super true. I did have one question as well. So you just buy mobile home parks you just buy the land or you buy like everything that's involved, like even the buildings on it. And then do you sell the buildings to some people or do you just rent them all? Like,
in a perfect world, I wouldn't want to own any of the homes, and we just own the land and rent the land. Like that's the ideal business model, but we don't live in a perfect world. So we do own many communities where we don't own any of the homes. Like all the homes are owned by the residents, which is beautiful because they maintain their home, they maintain their plumbing, the roof, electrical. Anything goes wrong, our only job is maintain basically the infrastructure and the common areas, roads, water lines, sewer lines, electrical, common areas, like clubhouses, pools, tennis courts, things like that. That's the perfect world. But again, we own a number of communities where we might own maybe a couple handfuls of rentals. And that's only because that's how it was run by the prior owner when we bought it from them. Our end game is to always sell those units off over time if we can. If the market dictates that, we'll sell those units off because there's not a lot of money to make on the rental game above the lot rent. Like all of our money is really made in the lot rent portion because there's low expenses associated with that. And so we just it also eliminates the need for us to have maintenance guys and repair guys either on staff or just relationships with them locally, which adds another element of just challenge. And then I think in our portfolio, we've got about 3,500 units at present time, like overall lots. And I think we own probably about 350, maybe 400 physical homes. Some communities have 40 or 50 of them. Some have 0. It just depends. But again, the end game is to not own them. But again, we're not in a perfect world. I don't think there will ever be a point in time where our entire portfolio is literally, we have 0 rental units or owned units in our property. So I just don't ever see it getting there.
Yeah. And if it got there, you'd probably just the next day you'd buy a new one and be like, I guess we got 40
That's right.
more.
I know. Here we go. Yeah. Starting all over again. That's right. That's exactly what would happen.
Well, I love it. And then is that why you kind of got into parking garages and stuff as well? Because I feel like parking is similar to mobile homes in a way of, like you're explaining there, like you're just kind of renting the land and you just have to deal with the infrastructure and stuff. And parking is the same thing. You're basically renting a spot to park for a short amount of time and you're just handling kind of infrastructure of it. Is that kind of the same game plan and why you guys decided to start purchasing those as well?
Yes and no. I mean, I guess you could, there's part of an argument there of like, just like people are parking their cars, right? And so it's just, you're not necessarily dealing with like, not necessarily tenants, toilets or termites. I mean, I guess you technically have tenants because some of our parking garages we have like monthly parkers that might work at local businesses that don't have their own parking. So they have to have a monthly parking agreement with us that could range anywhere from $80 a month to some markets, $250 a month. And then they don't get a dedicated space per se, but they have access to the entirety of the garage. And then we got transient folks they're coming for, maybe it's a sports event, maybe it's a court, whatever the local business nearby, demand is, like they're coming to park for maybe a few hours or maybe even overnight. And then we have arrangements with local hotels if we own it near the hotels, because most hotels don't have enough parking. So they have valet operations that literally need to use other overflow parking and garages. We've got agreements with office tenants. Like, for example, I mentioned we bought something in Charlotte. Our garage just happens to be connected by a Skybridge, the Bank of America headquarters right there in Uptown. And they have their own parking garage, but it doesn't support the number of folks inside their organization. And so I think we've got about 120 of the Bank of America parkers that park every day, day in, day out, month after month, year after year in our garage. And then Truist is also in Uptown. They're right around the corner. All those, they're all back in the office as well. And so they don't have the parking at their parking garage. Even though they've got this massive 40-story office tower, they've got their own parking. It's not enough to support support the entirety of that garage. And as you know, Charlotte's a driving market. Like everyone drives their car. There might be public transportation, but Charlotte's still very much a driving market. And so again, I guess back to the point of like people are just renting space from us. But the reason that what we got into, we just saw a fragmentation in the marketplace. Mobile home parks were probably that 10, 12, 15 years ago, where like not a lot of big institutional groups were in it. Like there's some big players, but not many. Like it's not a consolidated business model where you got literally like multifamily. 90% of the larger apartment complexes are owned by big groups, right? Like it's very consolidated. If you look back 35 years ago, that was not the case. Mobile home parks, even just 10 years ago, maybe only like 10% of mobile home parks were owned by big groups, maybe like ours or even larger. Whereas today it's probably like 50%, right? So it's becoming consolidated very quickly, and there's no new supply coming in the marketplace. So they're not building mobile home parks anymore. So you've got all this demand and no new supply, which is good to a certain point, but prices have gone up significantly. It's harder to find good deals that have the margins that we are used to 10 years ago. We saw parking as that opportunity to basically get it. They're not really building new parking. Basically, the cost, everything that we've bought has been below replacement cost. It'd be very difficult to actually rebuild anything today that we own with today's construction and supply prices. So for us, like they're not building more, so there's a barrier to entry. In fact, a lot of parking garages or even old parking lots are being redeveloped. And so for us, we look at it as it's a cash flowing covered land play. We're very strategic on where we buy it. It's got to be a phenomenal. We got to look at that piece of dirt it sits on as an irreplaceable piece of real estate, meaning that whenever the day comes, whether it's 10 years, 15 years, 20 years down the road, whenever we deem that parking isn't the highest best use, that we'll be able to knock that thing down and literally make even more money on the flip side by doing a redevelopment play. We don't underwrite the redevelopment play. It's got to make sense as parking today, but we know and we're very confident that parking is the lowest use that that piece of property will ever be. And so that gives us a comfort that we've got some room to run. And like I said, they're not building more parking. So like ever increasing demand for parking spaces, but like most of the industry is contracting. In fact, one thing that's really changed, that really got our interest about, it's been happening over like the last like probably 10 years, but really in the last like 5 to 7 years, most major cities across the country, Charlotte being one of them, they've eliminated the parking minimum requirements from new developers. And so historically, if a guy said, hey, I want to come in and build a high-rise multifamily property or hotel or whatever, you name it, whatever it is, in downtown or pretty much most other areas, a lot of it's downtown urban core, the city would say, hey, like you need to put in 1.8 parking spaces for every 1,000 square feet. They'd have some type of formula and they would require them to put in a certain amount of parking, even if it didn't make sense. If developers like, look, I don't need that much parking. Literally, only half my residents have cars. Like this is a younger crowd. Like they're taking public. It didn't matter. City still made them put the parking in. So they ended up with all this surplus parking that just wasn't being used. So those requirements have gone away. And so now developers, when they're building something new, if they're going to go in and take out a parking lot that's been maybe the surface parking lot that's been 250 spaces, they're going to build a development, multifamily. They're going to put in only as much park as they want to put in. And most of the time, it's not enough for every unit that they have. Like, in fact, because they're going to make more money on another multifamily unit than they will parking. And now, a lot of younger folks are taking public transit, they're taking scooters around, what have you. And so that's basically decreasing the supply of parking in all these urban areas, and they're not being forced to make any more. So if we can buy the right property in the right location, we know that there's going to be a demand for many, many years to come. And so, kind of like the one in Charlotte, it's right across from the, surrounded by hotels, it's connected to the Bank of America building. There's like bars and restaurants down there, but the Spectrum Center, literally right across the street, where the Charlotte Hornets play. They just re-signed their 20 plus year lease. They're doing a massive, I forget what's like a $500 million renovation. They're starting like literally right now on half of it. They're doing the other half next year. So I know that those things aren't going anywhere anytime soon. And so we just saw it as an opportunity to buy great assets and great locations that, again, really fit our model of cash flow, like cash flowing today. Like we want to buy something that cash flows today, but also has got an opportunity for us to add value for many, many years to come.
Yeah. And like, even when I drive around Charlotte and I see like the parking lots and stuff, I'm like, hey, that is probably eventually going to be like a high rise going to be built on that.
That's absolutely.
So like
inevitably.
Like your thought process of buying it for like cash flow now is like parking, but then, let it just cash flow. And then eventually that land is going to be worth a lot more because
that's right.
If Charlotte's growing so much and just putting up buildings everywhere, some developers are going to come by and be like, hey, I want that. And they're going to pay you either a ton or you can just build there yourself or partner with them or whatever you want to do. You know what I mean? So that's a really good point of view. And that's literally like what I was driving around and I'm like, I want to buy one of these because that right there, that big square with like 40 spaces of parking, someone's going to want to build there one day. I'm like, so that's super smart. Yeah, I'll have to go park at your garage and support you guys anytime I'm down there.
How it goes. Give me, Give me any feedback or positive or negatives once you go
I'll
there.
call you. I'll be like, my truck can't fit in here because I got too big of a truck. It's
That
hard
might
for
not
you to
worry.
fit in.
Yeah, I got a big truck too, and I have to be careful where I park. So yeah, I understand the problem.
But we'll start wrapping this up because it's been almost an hour, and I don't
Yeah,
want
and I do
to.
have to
I don't
jump
want
off
to.
here. So yeah, no, all good, all good, all good.
So I like to ask just three quick questions, and you can just quickly bang them out. So final three is basically you've done so much over your career, and you've been in real estate investing for so long. But like, what is your best piece of advice to just a new investor that wants to get started that just doesn't know where to start? And what would you basically tell yourself in the beginning?
Yeah, no, I mean, I think the interesting thing is when I started, there wasn't a lot of information. Now there's too much information out there, and so I think it just all goes back to the point that we hit on a couple of times is like kind of pick something, pick one thing. Again, there's not a right or wrong, and you're going to hear a bunch of other people saying how they made money in these other areas, and you can chase those shiny objects. But I can promise you that's not going to get you anywhere. Pick one and just like literally shut the world off, around you, and just focus on that. Get surrounded by people that are doing things that you want to do in that particular niche that are maybe 5-10 years ahead of you, and just golf yourself in it. And again, there's so much information out there that like at least if you pick a lane, you can only listen to information that's applicable to that particular lane, asset class per se, right? And just like literally go all in. And just it's again back when I started, like there wasn't enough information. Like now there's too much and it's a lot of noise. And so just find a kind of your immediate network. There's plenty of people out there willing to answer questions, help you, guide you, just support you in your journey. But the only way you're going to get there is if you just lock yourself down and stay focused. As far as like just the second question was, what advice is that? Second
Like advice. It was just a follow up, kind of like what advice would you give yourself back then when you were starting?
Yeah, I mean, I think the big one would be spend quite a bit of time running the exercise of like, where do you want to be in 5 years and not get so caught up in the day to day. And it's really hard when you're just rolling by yourself, but really try to take maybe it's an hour a week even and focus time of like, man, I know that I want to do big things and I got this vision board and I got all this stuff, but how am I really going to get there? And I'm not going to get there by myself. Be honest with yourself. Like you're not going to make it happen by yourself. You need to surround yourself with intelligent folks, other team members that are driven for the same reasons, that see your vision, that want to be a part of your journey. And I think the only way you do that is, again, that simple exercise of just building out. If you want to get to 100 million of assets under management, how many units does that mean in your particular niche? How many transactions if each one averages 5 million, 2 million, whatever, how many transactions, but then to buy that, to raise the capital for it, to operate that, like who needs to be on the team? Like who all needs to be on, and again, it's going to change over time, but like just give you a general direction that you need to work towards is going to help you make better short-term decisions as you're caught up in the grind day in, day out. At least you'll have like little bite-sized chunks of things that you need to work towards. Like, man, like my next hire, I need an admin assistant, or I need a leasing guy, or I need an acquisitions guy, because without those, I'm never going to be able to get past this plateau. Like I'm going to be stuck here because I don't have amount of time in the day. Like I don't have any more time left. I think that's an incredible helpful exercise. Like I wish someone would have helped guide me through that. And it took me many, many, many years to figure that one out. But that would be my suggestion.
Yeah, I think those are two really good points. And then we'll hop on to the next question just to keep this flowing. So based on too much influx of information nowadays, what is your favorite kind of business investing real estate book or anything that you would kind of advise someone to read? I know there's so much out there, and like you just said, but
it's so funny because I don't even listen to podcasts that much anymore because I have a hard time finding ones that it's like you go on Netflix to try to find a show to watch and you spend more time scouring through the bullshit, like the crap that's like, you're like, oh my God, there's so much on here that's not relevant. I don't care about. And then you just wasted all the time that you kind of allocated to maybe sit down and watch a show. Right. And I feel like I'm starting to feel that way with podcasts that like I've got a few, it depends on what I'm into. Like right now, I've been kind of on a health and fitness kick recently, just really trying to, I always like to try to switch things up a little bit and dietary habits and all that. So a lot of what I've been listening to isn't related at all to business. However, I know if I feel better and have more energy, that inevitably I'll be better in business. So as far as books, I do read quite a bit. Anti-Fragile is, and I don't know, forget the name of the author, is the book I'm reading right now at this present time. Then book I probably read once a year, which probably maybe there's two books I read once a year. Think and Grow Rich is one. Again, that's just a classic. And then How to Win Friends and Influence People are like the two that typically stay with me. I probably have bought multiple copies because I've worn out the other ones. And so if you guys haven't read either one of those, I think they're both incredibly applicable no matter what business you're in, what industry, what you're doing in life. You can find a ton of gold nuggets out of both of those publications.
Love that. Yeah, those are two excellent books. And I agree with you on the podcast. There's so many podcasts out there nowadays. I'm just like, I have like one that I like to listen to a lot. And then the other ones are just...
And I go through phases.
I
go through phases. Like I agree. Like there's some that I'd go all in and then I get burnt out and then I go months without listening to anything. And then I go try to find something on maybe a particular topic that I'm interested in, like maybe something I heard about, right? And it just leads me to a show that I actually like, not just that one episode, but maybe I really resonate with the host of the show. And so, but now I go through ebbs and flows of podcasts. But the reason why I started a podcast 11 years ago now is because I was an early adopter podcast. that's all I did. Like I drove a lot, working and buying properties, and I just listened. Back before people knew what a podcast was, I was listening to it, but there wasn't a lot out. So like I got to the point where I was like, type of real estate I want to be listening about, commercial real estate and all that. Like I can't find any good shows out there. And so that's why I started mine, literally, because it didn't exist back then. Now there's 1,000 other shows just like mine.
Yeah.
not like me, but obviously similar content, maybe similar.
Hey, you're the trendsetter.
Strategy.
That's why.
Yeah.
You're the trendsetter. You start the wave and people follow.
Yeah.
And then last question. This is mostly just for you to tell the audience like how they can reach out to you, social media handles, any meetups you run or attend, or charity events, business links, etc. This floor is yours just to kind of.
Yeah, I mean, you can learn about our company and what we do. We got quite a bit of information there. Investwithsunrise.com. There you'll find current offerings, past case studies that we put up of deals that we've gone full cycle on. We've also got a link to my podcast on there. And as far as like on social media, I'm pretty active on Instagram and Facebook and LinkedIn. Type in my name; it's the easiest thing to do. My last name's pretty unique, Bupp, UPP. So if you just type in Kevin Bupp on any one of those social channels, it'll track me down fairly quickly. I don't think there's any other Kevin Bupps that are commercial real estate, so I'm pretty easy to find.
Yeah. Well, I love it. And I'm going to put all the information in the bio of this as well. So whoever's listening, you should be able to get all that information, those links in the bio. So, but thank you so much, Kevin. I appreciate you coming on, and it's super interesting talking about mobile home parks. There's other aspects of real estate that I don't really get to talk to about a lot, and the listeners will definitely this one a lot too, especially with the experience you have. Yeah. Thank you so much again.
Awesome.
For coming on.
Thanks for having me, Wendell. It's my pleasure, man.
Sweet. That's it for us. So thank you all for listening.